Thailand's central bank has kept its key interest rate unchanged as policymakers balance rising inflation risk against a slowing economic outlook. In a unanimous decision, the Monetary Policy Committee voted 6-0 to hold the policy rate at 1.00%, saying the current level is appropriate to support the economic recovery. The committee signaled it remains cautious, noting the decision does not rule out future adjustments as it closely monitors inflation risk and global uncertainties. Thailand's economic outlook has weakened, with GDP now forecast to grow just 1.5% this year, below earlier expectations, before edging up to 2.0% next year. The downgrade comes as the Middle East conflict pushes up global energy prices, raising living costs and weighing on tourism and private consumption. Inflation is expected to rise above the central bank's target ceiling of 3% for a period this year, before easing to around 1.5% next year. However, risks remain, especially if shipping through the Strait of Hormuz continues to be disrupted. The committee acknowledges inflation is now its top concern. Policymakers say any move on interest rates carries trade-offs. Raising rates could further slow growth, increase borrowing costs, and weaken purchasing power. But cutting rates risk capital outflows, a weaker baht, and higher import costs, particularly for energy, adding to inflationary pressure. For now, the central bank says holding rates steady strikes the right balance as it navigates growing uncertainty in both the global and domestic economy.